Don't ask for what you think you're going to need in 5 years' time. Ask for what you need now, so this way the amount that you're asking for from the bank might be on a more limited basis that they could potentially wrap their hands around. But the more you can come having prior experience in the field that you're starting a business is key, very key. You can't be, a lawyer who wants to open a restaurant, and just because you're a successful lawyer doesn't necessarily mean you're going to know how to run a restaurant. Conversely, if you're a lawyer, we're working in a restaurant through school, but now you have years of law experience being a lawyer at another firm, but now you want to open your own practice, that's going to speak to your ability to be successful in that field.
We have a very special episode today for everyone. We're going to dive back into access to capital. We have an expert, a relationship manager directly from TD Bank. His name is Scott Horowitz, and this man alone, over the course of the last 12 years, he's helped small businesses secure over $100 million in funding, which equates to, on an annual basis, $8.3 million per year for small businesses. And so rather than me trying to fumble through his extremely robust bio, I'm just going to hand it straight over to Scott.
Thanks.
Yeah, it's so good to have you on the show.
Great to be here.
We appreciate it. So give the audience a little bit of your background, your history, how you got to where you're at now, and what are your roles and responsibilities? Sure.
I'm homegrown at the bank. I've been with TD for over 21 years. Started thinking it was a temporary gig, and it has turned into a 21-year temporary gig.
It's like the story of most people's lives, right?
Yeah.
I'm going to do this for a little bit, and then it turns out I'm pretty good at this.
Yes, I forgot to leave. I've never left. So I started off on our retail network. I started as a customer service rep, pretty much a year out of college, and quickly moved up, became an assistant manager of one of our locations, moved to a different location, then opened we call it de novo store from scratch in Franklin Square for TD. I was there for 4 years. It was a great experience. And then I've been in this role for the last 12 years as a relationship manager. And I work with small business owners every day. They are my client base, and I work with them on all their banking and financing needs. So if they need lending, most of my clients have some level of lending. But if they just need treasury management services or banking services, I have plenty of clients that don't have any sort of lending. And their go-to at the bank, whatever they need, I either sell them the product themselves or address the problem or question that they have, or I bring in the appropriate product partner.
That's great. Every location you've been has been in New York, correct?
Yes.
Okay, that's great. And to have somebody with that level of experience, and I hope that this helps break the mold for people. A lot of people think of bankers as being somewhat disconnected from the community, not tied in, don't really know what's going on, and they're just the holders of funds that are looking to say no to you when you come in and ask for money. But like you said, your client base, what you do every day is actually work with small businesses. And even in a capacity where they're not getting lending, but they just need to have like a business bank account set up so they can handle their financials in a little bit more effective kind of manner.
Yeah, at TD, it's really a team effort. So I'm personally not located in a particular TD branch location. I work with them as partners. So you kind of get a team of people. So based on what your needs are, we'll determine who your main point of contact is. But to your point about communities, working in the community is really the best part of the job. It's the most rewarding, and that's where all the action is. Every business is part of their local community, and the more that we could do to work with them and support them, it works for everyone.
100%. It's so true. So we're going to focus 90% of this conversation all on businesses that are established, doors are open, they're making sales, and they're looking for lending. And so we're going to walk through that kind of life cycle of this, from their conception of I need this money all the way to I have the money, now what do I do? But right before we get into that, my heart goes out to all the startups, the people out there with their ideas that are looking to get started, because there's so much of our client base. And so I know that getting money for startups is very difficult with almost every single bank. They're not. So I'm just curious, from your perspective and from TD's perspective, what are the friction points? What are the obstacles for startups in getting that money? Like, why is it so difficult for them?
Sure. I think an overarching theme of why banks have a hard time lending to startups is banks are in the risk management business. We have to assess risk on every request of money, regardless of how big or small it is. Banks like to do that and mitigate their risk based off of prior performance. And so startups don't have that prior performance for the banks to hang their hat on and say, well, look, this is what they've given us their financial statements. They've proven that they have the ability to repay this loan. Startups don't have that luxury.
Correct.
Obviously, every business starts somewhere. The best thing for a startup to do is have a business plan. It's not going to be an easy path forward with a bank. Sometimes you have to go into your own pockets, approach family and friends, and also start small. Don't ask for what you think you're going to need in 5 years' time. Ask for what you need now. So this way, the amount that you're asking for from the bank might be on a more limited basis that they could potentially wrap their hands around. But the more you can come having prior experience in the field that you're starting a business is key, is very key. You can't be, a lawyer who wants to open a restaurant, and just because you're a successful lawyer doesn't necessarily mean you're going to know how to run a restaurant. But if you're opening a restaurant and you have years of experience, or conversely, if you're a lawyer and you were working in a restaurant through school, but now you have years of your law experience being a lawyer at another firm, but now you want to open your own practice, that's going to speak to your ability to be successful in that field.
No, that makes some. I'm so glad that you went to those examples, because that's exactly what I was going to bring up to you to see how that changes a bank's appetite when it comes to. We know some people that have worked at the restaurant. They started as a server. They work their way maybe back into the kitchen. They become a shift supervisor, and they keep working just like you did with TD, right? They keep working themselves through the ranks, and they go higher and higher to the point where they're maybe in management, but they're not an owner. But as time goes on, like that takes some time to get from server to manager.
Right.
And so that's time on the owner's life, just being, straightforward as possible. A lot of people are looking to retire. They're looking to sell their businesses, and so they can go and enjoy the rest of their life however they see fit. And so oftentimes those relationships that are established between that person that's decided to work themselves through the ranks and that owner, they're pretty strong. And so they would be more inclined to sell it to them because they already know the business. They feel maybe like it's part of the family. And so something like that, I would imagine, is more appetizing to a bank, even because that's still technically considered a startup. Is that correct? Because it's
in certain respects, yes. Yeah. And that's a great point to bring up, because, as businesses transition from one order to the next, the experience, again, if it's an established restaurant, and I shouldn't use restaurants because restaurants, startup or not startup, are very difficult to get financed.
For the risk management.
Yes,
right?
As an industry. But we'll just stick with the restaurant example. If you are buying an established restaurant that is very successful and you can provide financial statements showing that it's successful, but you have no restaurant experience, that's going to be something very difficult for the bank to wrap their hands around, because how do we know that you're going to be successful in this business? There's no track record there. Right. So keep that in mind. Borrowers should keep that in mind as they approach a bank, that would be kind of a strike against them that they're going to have to overcome when they are proving to the bank, this is why I'm going to be successful. And it could have been prior experience that they didn't have in their most recent employment, but they do have experience in the past, or maybe a spouse that's going to be involved in the business has the experience in that industry. Those types of things are impactful and important as a borrower sitting with a banker. The more information that you can share, people sometimes are like, well, I don't want to give too much information. The more information, the better, because inevitably, if you don't share something, we're going to find out anyway. And the more I have that information up front, the easier time I have going to an underwriter to say, these are some risks. Yes, we acknowledge that, but here's how we can mitigate that. And if I can go in more prepared to that conversation, it will work better for everyone.
That relationship is so important to understand, is that you're the relationship manager is not the person that says yes or no. Like you can say no earlier on, and it's not typically a no. I don't think from my understanding, and obviously you know this way better than I do, your response rather than no would be, this is what we need to work on in order to get there.
Correct. My job, if somebody comes to us and wants to apply for a loan, our job is to help them apply for that loan the best possible. But if I'm doing my job well to help that client, it's to sit down and be a trusted advisor to them and say, this is what's good, this is what's not good, this is what we're going to be up against, and let's put our best foot forward and try to get it done. Sometimes we're successful. A lot of times we're successful. Sometimes we're not.
Yeah. And so I think on the last note for startups is, we get a lot of people that come in and maybe they were just released from their position, the company was downsizing, and they see this as an opportunity to go out there and start their own thing that they've always been passionate about. And listen, I'm all about it, but I think it's important to consider this conversation that we're having, and maybe the next best step is to actually find somebody that's already doing what you want to be doing and see how you can get involved with their business. Even if starting out, just like you said, your position starting out wasn't what it is now. Maybe you start out just as somebody who's managing appointments for, like, if you want to get into consulting or something, and you're like, okay, well, what if I can just be your virtual assistant and I'll manage all the appointments, I make sure I communicate with you and everything's in order. But then you're getting a look at the inside of the business, how it runs. You're building up your own experience in there that is then transferable to that conversation with the bank, and just for yourself operationally. If it's something that you've always wanted to do, but you don't really understand the business side, go look for employment there if the opportunity arises, and start to gain some experience that way. And then that can lead to a path where you'll be able to position yourself better to potentially get lending or whatever the case may be moving forward.
Yeah, absolutely. I think there's pros and cons to trying to start something from scratch versus going in like a path that you just were outlining of going into a business that's already established that may have an exit strategy in the next few years, and you could buy into that. We do a lot of healthcare lending, so we run into that a lot where a doctor or a dentist is faced with, do I start something from scratch, which is very capital intensive and no patient base, or do I go into another office that's established with a retiring doctor that wants to sell that I can, maybe it's not exactly what I want it to be, but I could turn it into what I want it to be, and at least it has the revenue stream that's already outstanding and there that I don't have to build from scratch. Pros and cons to both ways.
Absolutely. I've always been fascinated by that. I want to get to our established businesses, but I've always been fascinated by this, but specifically in these type of healthcare practices. So for dental in particular, getting your teeth worked on it can be very traumatic for a lot of people. And so going in and establishing, I wasn't going to say it by name, and I was like, there's somebody in the room that does not like that. And it's also the mother of my children is the same way. And some of my kids have adopted the same thing where it's just like this huge traumatic event.
Sure.
I don't care at all. But for those, it's establishing that relationship with the person that's there, and that person typically has like their name on the door and everything. I've always wondered how much of an impact that has when it comes time for them to retire. Because as somebody who's typically, there's not just one dentist in an office, right? There's several others, but it's owned by one or a couple. But when it's time for them and they're like, all right, I'm on my way, and I'm willing to sell it to Win or all of the rest of you. Like, how does that impact the business when people are like, oh, it's not Jim anymore. I know Jim. I like Jim. I don't know you guys.
So usually we see that there's a transitionary period where the exiting doctor will stay on for 3, 6, maybe even longer months to transition and introduce the new doctor to the patients. And I think that you naturally, in banking and dentistry, whatever the industry, if you're dealing with somebody over a period of time, you develop that personal relationship. Right. So you don't necessarily, even though, yes, it's a new person that's going to have their hands in my mouth, you are comfortable with the office. You're a creature of habit. This is where I've been coming. They have my file. And if this person that I've developed a rapport with that I've trusted for all of these years is selling to this person, then I'm going to give them a chance too.
And especially, like you said, when you're doing the active handoff, where you're not just, hey, I'm leaving. Someone, this other guy's coming in and buying it. This other gal's coming in and buying it. They're great, and I'm out. But if you're actually doing that thoughtful transition, and you see that in so many businesses where the CEOs, I think it's just standard practice that typically when you're selling your business, part of the sale is that CEO is actually going to stay on board for another 12 months just to ensure that the transition goes well. So that makes a ton of sense. I'm glad. Now, see, I've had that like picking at my brain for like 6 months now, and I finally have a good answer. Thank you.
No problem.
All right. I guess right before we get into the operational businesses, the last thing that I wanted to touch on that kind of hits more on that startup space is just the business bank accounts. So if you could just briefly describe how that works from what are the options, what are the levels? Because I know that some banks you have to have a minimum amount in there, and then there's potentially different tiers of these bank accounts where you have different services offered to you, like payroll and things like that. And so I'm curious, what does TD offer? What are the different tiers if that's how it's broken down?
Sure. Yeah, we try to keep it as simple as possible. We have 3 kind of intro checking accounts. One of them is called our simple checking. If you don't want to have to worry about a minimum balance requirement and whether you're going to be charged a monthly fee or not, the simple account has no minimum requirement, has a very low monthly service fee. So there is a fee, but you don't have to worry about going under a minimum balance requirement. And then it goes up from there. Our next tier account only has a $1,500 daily minimum, which, is fairly low in the marketplace.
It's very low.
And all these accounts you're getting, free online banking, free bill pay, free debit cards, Zelle for small business.
Really?
It comes with those services come regardless of what level of account.
So even at the simple one.
Yes.
Oh, that's incredible.
Right. So it's important as somebody, especially a startup who won't have a lot of money at the start, to make sure that they're getting the services at a low cost and that they are building a relationship with a bank that they could see. Hopefully that business does grow. That's convenient for them, not only physically located, but their hours, and making sure that, if they're cash intensive businesses versus check intensive business, if they have the services and the hours and the convenience that they need. A lot of things are digital these days. So having a strong online presence, but also a physical presence, that's really the research that we've done, is that people definitely want to be able to do things online and they want to do things independently. But when they need something, they want to be able to come in and see somebody. And that's why we continue to maintain a strong branch network.
That's brilliant. I felt like I was just being described there. It's because I have USAA Bank for, I'm as a veteran, and I had it the whole time that I was in the Army. And it's great. They're phenomenal. They do a good job with insurance. They've always done right by me. But there's the physical locations. There's like 2, like in the United States. I mean, there's more than that, but there's very few, and I've never been to one. I've never seen one. I hear that they exist. It's like that mythological creature that's out there, I'm sure. And that's very frustrating. And so to be able to have that kind of spread, I guess that goes, where is TD located? Is it specific states, specific regions? Is it national?
We are pretty much the entire East Coast from Maine to Florida, except for Georgia. We don't have any physical branches in Georgia, but pretty much every other state. We're biggest in the Northeast, all the way, New England. Metro New York is very big. Metro Philly, DC, and then Florida is a big market for us. But the states in between, for the exception of Georgia, the Carolinas, Virginia, Delaware, we have a presence.
Phenomenal. I'll be looking for you guys in South Carolina here in a month. There's a great amount of options and the flexibility. We've spoken with other banks where their minimum account threshold that you have to have is more than 5, almost 10 times the amount that what you guys are requiring. And that's not even the bottom level. You can actually just go in. So it's a great option for startups that people are looking to get that established. And it's something that we recommend from the SBDC, is that, we refer to the acronym BAIL for your startup, for your team, for your business team. So business bank account, an accountant or a CPA, look into insurance, and look into legal representation. And so those should be kind of the baselines. The first thing we always recommend, and it just so happens to be the beginning of the acronym, is the business bank account.
Yep. And like I said before, we try to be a trusted advisor, just like your accountant and your lawyer are trusted advisors. Sometimes people will come to us for guidance on a future need, and that's fine. We are happy to do that because you may not need lending today, but you might be on a trajectory where you need lending in the future, and you want to know, what do I need to be prepared for when I get to that point? And so we try to act as trusted advisors in that capacity.
And that's great. And that's where a lot of the relationship between the SBDC and regional banks such as TD come into play, because they'll start thinking about that projection into the future and like, okay, well, this is where I'm at now. I know the sales I have coming in. I'm trying to grow, but I know I want a building, or I want this and it's going to cost this amount of money. And so they can speak to you and you can give them the guidance like, this is kind of what we're looking for. And we're definitely going to dive deep into that here in a moment. But then they can come to us and we help them to work through the actual development of that business plan. And we collaborate again with you guys and we work together as a team on this. And so it's a really great community once people are aware of all of these things that are actually available to them. Absolutely. All these resources. So that's incredible. I really hope that we're breaking some of the mythos around the banking industry for small businesses and with banks such as TD, because it's a powerful add-on to your business.
Yeah, every business owner should know their local branch manager. At some point, you're going to need somebody, and you don't want to have to first introduce yourself. You may not be in there very often. You may not be talking to them frequently, but if you have a question or a problem or something is an emergency, being able to come in and say, oh, remember we spoke that time, or even better, they're very familiar with you. Right. It's going to be a much easier experience because there's some familiarity there. And every banks are businesses too. They need to grow their business, and branch managers are tasked with growing their local business, which is their branch. So they need you just like you need them. And so that it's a two-way relationship. Absolutely.
And so much of business, almost all of business, always just boils down to relationships. So it's 100%. What are the strengths of your relationships? And there's people always talk about networking and going out and you're meeting other businesses, you're going with the Chamber of Commerce, but establishing that relationship and not showing up to a bank at the time when you're like, okay, I'm ready. Here's my request for the loan. But if you actually have that relationship already, then the bank's already familiar with what you're doing, how you're operating, and if you're keeping them updated, that's nothing but a benefit for you when you go for that ask later on.
Absolutely.
Great. All right. Now we're going to get to the meat and potatoes.
All right.
Now the focus is going to be businesses that are already up and running. The first thing that I want to look at when it comes to lending is what markers should a business look at to determine if lending is even a good option for them? Like what have you seen with your experience in working with small businesses over the last dozen years? What are the signs that someone's actually in the position where like, yes, lending is a good idea?
Mm-hmm. So if they are at a point where they need to get to the next growth step in their company, if they don't have the capital on hand to be able to do that, but they know that that's the direction they want to go and they believe in their business plan, then that's a good opportunity for them to approach a bank for financing. Sometimes people do have cash on hand to be able to do it, but they're tired of using their own money and they want to reap the benefits of all their hard work of being a business owner and want to be able to take those distributions from the company and not solely rely on the keeping the cash in the bank. And so that's also a good time to go to a bank. Having a line of credit, regardless of the size company you are, is a very important tool to have and product to have from the bank. Again, even if you're not relying on it, you might be flush with cash and you don't need to depend on it, but it's an insurance policy. You have it there for a just in case. There's so many different examples that you could give to unexpected instances in your business. The extremes, Hurricane Sandy, no one saw that coming and that businesses were shut down for weeks without power. Most recently, COVID, but even more recent than that, if you're an importer exporter, you weren't expecting that a ship was going to hit a bridge and dramatically impact that area of goods. If you had product on that boat, you're dealing with that. If that port had product that you would import into and now it's closed, that can impact you. You don't know what's around the corner. It could be as simple as a client that normally pays you in 30 days all of a sudden is paying you in 60 or 90, and you were always dependent on that cash flow cycle. Things like that. It's an insurance policy. Let it sit there. Just because you may not file a claim with your insurance company doesn't mean that you're canceling your policy. It could sit there, and the amount of it can grow over time as your business revenue grows, and the bank really wants to grow with you. It's not a one and done request. So that's really just an underlying recommendation of when or why you would approach a bank for financing.
And so when it comes to the line of credit, there's no penalty for not using it. You can have it there. It's fully funded and you don't touch it for a year, 2 years. And there are no negative consequences to a person for doing so.
So typically the expense that comes along with a line of credit is obviously the interest that goes along with the portion of the line of credit that you use. That's kind of the nice thing, is that you're only paying interest on the portion that you use for however long you use it. So if you're not using it, there's no interest expense. The other cost, really carrying cost, is typically an annual fee. Mm-hmm. The bank, if you're not using the line of credit from the bank, it's actually costing the bank money. Because
that makes sense, because the idea is the way the bank gets money is through payments on the interest rate, or the interest rate payments.
Right. And there's capital requirements that the bank has to meet. So there's typically an annual fee from the bank that will go along with it. SBA lines of credit don't have annual fees. Okay. Those are generally the expenses. And to your earlier question, is there any harm in the line of credit just sitting there? No, I mean, with TD, that's fine. Mm-hmm. I've randomly heard other banks will pull back on the line if you're not using it.
Interesting.
We don't have that at TD, so people will come to me saying, oh, should I use it just so I could show that I'm using it? And it's like, it's great for the bank if you do that, sure, but for you're paying interest really for no reason.
And so even for those people that are listening are not from on the East Coast, these are the types of questions that you can go to your regional bank in those areas and ask them. And so this is the kind of insight. So like I said, even if TD is not in your scope or you're not in that region, these are the things that you want to know. So when you're going to a bank and you're looking at that line of credit to have for that rainy day, just in case something happens, these are the things you want to know. So that's very powerful. So now I want to get into kind of the packaging aspect. So we know we've touched on, when does a business need to reach out for lending? And it's basically, I mean, if it's going well, the idea is, demand is outstripping supply. And so if that's happening, then you're well positioned to go get a loan to either add an additional workforce if you need to cover the upfront expenses and everything like that, or if you're looking to open another location or whatever the case may be.
Yeah, I mean, if you have a big capital expense, which could be in terms of an expansion or you're buying equipment, you really want to finance that over a longer period of time. And really, when a borrower approaches us for financing, and the question is, what type of financing should I get? We really try to match the product to the purpose. So a capital project like that, let's just say somebody's buying a delivery van. Mm-hmm. Well, you don't want to use a line of credit for that. You want to capitalize that and finance that over, 3 years, 5 years, 7 years, whatever it is, and you're going to get a fixed monthly payment, and you know what that is. Just like an individual is going to go get a loan for a car payment, they know what that is. They're not going to buy that on their credit card. That's really, the line of credit is really just meant for short-term working capital needs to manage your cash flow cycle. And so to your point about when to approach a bank for financing, if their need to buy a van, let's say the van is $50,000, and you're going to pay for that up front, does your business need to replace that $50,000 for their operational purposes? Right. And if the answer is yes, then don't pay for it out of pocket. Finance that. And that, the finance costs for that is a cost of doing business, because you need the capital to remain in your business.
Yeah, 100%. And that makes it so you don't have to tap into your line of credit to potentially cover even employee wages or something like that because of the purchase of the van. You're getting that financed instead, and so that's very interesting, because I am curious about the different types of lending, like what are the different ways people receive money and what does it go for? So I think maybe we'll just dive into that now, and then I'd like to look at what does a business owner need to have prepared when they come to you?
Absolutely.
But first, let's look at, so we talked about a line of credit. Line of credit is similar to a credit card in the way that it's used, in that you have an available amount that's there for you. You use some of it, and then there's going to be interest that you're going to pay on that amount that you use. Does it work the same way as a credit card, in the essence of, if I make an expense on it and then I pay that off like right away?
That's a good question. With a line of credit, you're paying interest from day one.
Got it.
So even if you pay that off entirely at the end of the month, you're paying interest on the time that you're using those funds.
Okay. No, that's good. That's really good to know. Okay.
It is very good to know. And also, as people are approaching their bank for the details of the parameters of a line of credit, for us, our line of credit required monthly payments are interest only. You are responsible for managing the principal balance on your own. We do want to see that it fluctuates with your normal course of business and that you don't just take a line of credit, max it out, and pay us the interest. It's profitable for the bank, but not what we want to see. We want to see that you're managing it appropriately. But other banks, their line of credit product could have a principal and interest component to it. And so that's important to know upfront also.
Again, more questions to ask the bank. When you're shopping around and you're trying to find the bank that is best fit for you and your business at that point in time, these are the questions that you need to be asking. All right, so that's the line of credit. And just briefly, I guess we'll touch on a business credit card just to stay on kind of like the lower end of things.
Sure.
So we kind of touched a little bit on the difference now. We know that you're going to pay interest on the line of credit regardless. Credit card, a business credit card, same way as a personal credit card, correct? Where if you pay off your expenses at the end of the month and there's no interest rate.
Yep.
Is there any other particular difference or uniqueness from a credit card versus a line of credit? And when would you recommend a business having one versus the other?
Sure. I mean, a lot of times they could be used in tandem. You know, credit cards obviously have all the rewards tied to them that people like to get on there, which can support them personally or their business. So they could be used in tandem. It's in place of a line of credit if you're just looking for if you just need some buying power, if you're, small business, a startup, a solopreneur, what have you, and you need, I'm just using these numbers, but $10,000 to $25,000 a month of buying power, and you do intend on paying that off in full or almost in full every month, you could probably get by with a credit card if it's mostly purchases that you're making that accept credit card. If you're looking to do cash advances, that can become very expensive to do it that way. But at the low end, it could serve the same purpose as a line of credit.
Okay. And so now going up to a little bit more of those higher dollar amounts, if someone's looking to make an expansion, like a physical expansion to their building, or they're looking to purchase another one, or they're looking to upgrade their equipment or purchase additional equipment for their business, what are the different ways? How does the financing work for them in those different situations?
Sure. So there's several different vehicles that they could use to purchase equipment and or a building. So on the equipment side, we offer term loans as well as equipment leases on new equipment. The benefit of an equipment lease is you can finance 100% of that purchase, and also some additional if there's delivery or installation costs or software that we can include in that. And it limits your out-of-pocket expense. And in the state of New York, we are able to include the tax in your monthly payment. So it's limiting how much you need to take out of pocket. Again, that's on new equipment only.
Okay.
Other states, the tax works a little bit differently where it is paid up front, similar to how we would treat a term loan. A term loan, we're not going to finance 100% of the purchase that you're making. We're going to look for you to inject, typically 20 to 30% of the purchase, and then anything delivery, installation, tax, you're going to pay out of pocket on your own. And so those are the two for equipment purchases. If it's a large equipment purchase, there's also the SBA 7A product that's available, which can also be used for building purchases or both. A lot of times SBA financing is a good tool and a good resource because you can finance the purchase of the building. If you have moving costs, if you have outfit, if you need to do any work to the building, if you need to purchase new equipment, the SBA does allow you to do one combined loan for all of that. And the term of that will depend on what you're using the money for. Typically, a building purchase, SBA, we can finance over 25 years, whereas a non-real estate transaction for SBA is limited to 10 years. So they kind of do a combined term based on the usage of that. But that's another avenue to do that. If it's just strictly a building purchase, and SBA, it's important to know it's only owner-occupied. So if somebody is looking to buy an investment piece of property, or if they're going to occupy less than 51% of that property, in the eyes of the bank and the SBA, it's going to be looked at as investment because the primary purpose of that is and the revenue stream is coming from another source other than your business. But there's SBA and conventional bank financing options for owner-occupied real estate, as well as investment real estate, which could include residential, mixed use, industrial, office space, commercial. So really the property type runs the gamut.
Okay. So, and just to make sure that I understood this correctly, are you saying that TD, if we're not going the SBA route, will TD finance a non-owner occupied? SBA will not. It has to be owner occupied, 51%.
Correct.
Which includes like stairwells and closets and what have you.
It could even in certain circumstances include parking lots too.
Interesting.
Yeah.
That's good to know.
If a business, like I did a SBA 7A for a contractor, and the purchase was important to him because he needed a lot to park all his trucks. And so he was going to have a subtenant. He was without the parking lot, he was probably going to be above 51% anyway, but with the parking lot, he was definitely going to be above it because he had the full lot and it was for his business use.
Yeah, it's a huge additional amount of square footage to throw on there. Just a little buffer.
Totally. Yeah.
That's great. And so TD you will work with businesses that are looking for investment properties.
Yes.
Okay, great.
Yep.
That's what I thought. Okay. So now let's look at that loan packaging. Let's see, what are you looking for from a business when they show up? I know we work with a lot of small businesses and preparing them to come to you guys and other banks wherever the fit kind of makes the most sense. And so we help them prepare business plans and we help them with several other documentation that we've got a feel for what you guys want. But just for clarity's sake, what would give you the reaction of like, oh man, this is really well put together. My work's done for me.
Sure.
What are they showing up with?
Okay. So in terms of financial statements, what we're going to ask for is going to be dependent on how much you're looking for. So asking for a $25,000 loan is going to be different than asking for a $250,000 loan or higher. Pretty much, we have a loan program up to $100,000 where upfront you're really just filling out our application. It's a streamlined. We usually have an answer to you in a couple days. Sometimes after the fact, we might need to ask for verification purposes for your most recent tax return, but we don't need it upfront. Once you get above that $100,000 mark, we're asking for at least 1 year of tax returns upfront. We have a loan program that is up to $250,000 that we will ask just for that 1 year of tax return and our application, be able to give you an answer within a couple of days as to whether you're approved or not, and we could have it closed within a couple of weeks, have it funded.
So what? So it's just the tax return?
Yes. So in that loan program,
hello.
Yes.
Hello, TD.
And really the genesis, I mean, we've been doing that for several years, but really, there's plenty of online lenders that got into that market first. Other banks traditionally have always done their hard look underwriting, cash flow analysis, collateral analysis, and all the online lenders of the world. I won't name any names, but they would just take a bank statement and say, all right, we're comfortable giving you this money. Mm-hmm. It comes at an expense. You're dealing with a non-bank financial institution who is not governed by or is not regulated by the government, so they can kind of do what they want. They can set whatever terms they want. And so this product kind of morphed from, that marketplace being a competitor. But really with the technology today and the ability for us to not just look at your credit and not just look at a tax return, but really kind of get an understanding of your transaction volume, kind of gives the bank the comfort level. And again, up to that $250,000, it's meant to be a streamlined process where we can give you an answer within a couple of days. We're not doing a cash flow analysis. We're not doing a collateral analysis. And there's plenty of businesses out there that don't necessarily have the collateral for a $250,000 request, but still warrant having a $250,000 facility. So it's really, it's geared to that market. It's across different industries. There's some limitations, but that's our product. So it's very limited up to that dollar amount, what we're going to ask for in terms of a tax return. Once you go above that mark, you should expect to provide 3 years of business tax returns, 2 years of personal tax returns. If it is a line of credit, we're going to ask for an accounts receivable aging and or an inventory listing, because generally speaking, a line of credit being for short-term working capital, that's how we're going to collateralize it. If you don't repay, if you default on your loan and the bank needs to try to recoup their losses, they're going to look at what receivables might still be outstanding. And if you had any inventory, non-perishable inventory, they're going to look to see if there's anything that could be liquidated.
Got it.
At the end of the day, if you're in a default situation, does the bank have the likelihood of getting repaid from one of those sources? Probably not. It's going to be, if you're not able to collect on it and that's why you're defaulting, chances are we may not be able to collect on it either. But those are the basic parameters that a bank will use to guide them in what the appropriate size facility that we would offer to you.
Okay.
And again, that's really in the over 250 world. Besides financial statements, the best thing that you can do to come prepared is know your business. The worst answer when I say to a business owner is, what was your revenue last year? And they say, I don't know. My accountant handles my taxes. That's not a good answer. That's not what I want to hear. Right. I don't need you to be a forensic accountant and tell me to the penny what you did in revenue. But if you can't tell me that you did 5 million or 500,000, that's not a good start.
Give me at least a ballpark.
Right.
What are we working with?
Right.
What range?
You know, you should be able to say, yeah, last year we probably did about $2 million in revenue. If you like say, I don't know, I'm sitting here saying, well, if you don't know, who does know? And your accountant's not in your business every day. So having a loose understanding at least of your finances is important, but really being realistic in your ask. Again, like I said earlier, you don't need to ask for the amount of money that you're going to need for the next 5 years. Ask for what you need right now. Ask what you need in the next year. The bank would love for us to give you a loan. You use those funds, you grow your business, and you come back to us in a year from now and say, look what I've done. I've grown my business, and I need more. That's not a negative to the bank. People perceive that as like, well, yes, I don't want to have to come double dip. It's not double dipping. We're growing with you and being a partner to you, and we would love for you to go from a startup phase to a very mature company, and TD was the one that helped facilitate that. That's the best feedback I get from my clients. We're like, oh, you've been here along the way. That's what we want to hear.
Yeah, again, it goes back to those relationships,
right?
You know, and understanding that it is a relationship, it's reciprocal. You know, all parties are benefiting from this, and so that's good, because I've heard from other lending institutions that they would rather loan more up front, and it would actually be a negative for somebody to come back 12, 18 months later and ask for more. So they tell them to over ask in the beginning. So this is really good insight.
I think that it depends when you come back in 12 to 18 months, if you're sucking wind and you can barely make your payments, then yes, then I agree with that. It's not going to look great. But if you did what you were hoping to do with that money, and you could say, I went from, A to B in terms of revenue, and, you're in good standing with the bank, I don't see why we wouldn't look highly upon that and say, all right, look, they did what we wanted them to do. They were responsible with what they asked for. They did what they said, and now they're asking for more to get them to the next level. So I don't see that as a negative.
That makes sense. And then that is a perfect distinction between situations. It's not coming back out of a state of desperation, right? It's coming back because you were able to execute effectively on the plan that you had with the money that was given.
Right.
Right.
And don't come back to me in 3 months saying it wasn't enough. That's a bad look.
Yes.
That you should, again, it really depends on the amount that you're asking for. In this under 250 space that I keep talking about, it's very formulaic. We're going to look at your prior year revenue, and we're going to say, all right, based on your revenue, this is the appropriate size. Let's say it's a line of credit. This is the appropriate size line of credit that you need right now. So if you apply for the maximum amount, you're not going to be able to come back in 3 months and say, I need more. But if you come back in a year from now and say, well, now look at my revenue, then we would be in a better position to say, all right, that makes sense. Let's look to increase your line of credit based on that increased revenue.
Right. And so that 250, is that pure line of credit, or can that come in many different options? Term loan and
correct.
Okay.
Many different forms.
Perfect.
Or a combination.
Oh, and that's really good to know, because to hit those different parts, if you're looking for the equipment, maybe you're looking for those initial, would you say if you're looking to hire several more people and you want to be able to cover their wages for the next 3-6 months while they're getting to the point when you're getting your ROA on bringing them in, is that a kind of a line of credit situation, or how would you recommend that gets packaged?
I think it could be done either way for a situation like that. If you know what your expansion costs are going to be and you want a fixed payment to be able to pay that back over time, then a term loan's not a bad direction to go. Okay. If you think that you are going to get that return by that hire in the next 3 to 6 months and be able to chop that down on the line of credit balance, then a line of credit is also a good way to go. People just sometimes get into a bad spot where they're like, oh yeah, I'll be able to pay this back in the short term. And then the next project comes up and they're putting their capital towards that. And then the next project comes up and they put their capital towards that. And then years later, they turn around and they've been paying interest on this line of credit balance. And they run the risk of the bank saying, look, you haven't paid us back any principal. We're going to turn this into a term loan. And sometimes that is favorable to the client. It's like, you know what, I should pay it off and that's fine. But in other times, it's like, well, I really need it, even though it's, maybe it's maxed out. I need it to stay as a line of credit, either because the monthly payment is more favorable. That's where people kind of get into trouble if they can't manage that, if they don't trust themselves to manage that appropriately. But I think both have their pros and cons. But I would say rule of thumb is if you think that you're going to be able to pay it back, or at least start to pay it back in 3 to 6 months' time, a line of credit is probably the better way to go, because as you pay it back, you can use it again. So
I think it's a really powerful way to kind of reverse engineer what you actually need, because sometimes you're just existing and you're seeing that we could really be open for another 5 or 6 hours. It turns out the walking traffic is tremendous. It actually extends past this time. We're closing down too early, but I can't overburden my employees. I got to hire some more people for these additional shifts. And so if you look at it from the financial perspective of what the impact of the lending is going to be, and you reverse engineer that back, it can help you to determine exactly how many people is appropriate to bring on for that position, rather than just looking at the straight needs of the shift and everything. And so it's good to feel it out and to do some financial planning when it comes to these things, rather than just going off what you feel is good in the moment.
Yeah, totally. Even if the whatever you're asking for from the bank's not going to ask you for projections or a business plan, as a business owner, that's still good for you to do your planning. Yes. To be able to do projections. You don't necessarily have to write out a formal business plan because you know what your plan is for your business, but at least putting pen to paper with what your expenses are going to be, what you think the return on that investment is going to be over what time frame. And yes, that will help you determine A, whether it's a smart move, but B, if you are going to approach a bank, how much you think you need. That was really good. It's a good segue into the next point I want to make is being prepared when you go to a bank. I don't know if this is just a personal pet peeve of mine, but when I say, well, what is it you're looking for? And the answer is, well, how much can you give me? I don't like that response because it tells me that you're just looking for as big of a handout as possible, and you don't know how much you really need for your business.
Yeah, if that's the answer, then you haven't taken the time to break down I always tell people to create a byline, like line by line, write down what you are looking to do and what is the kind of purpose behind it. Like, I want to put this much into marketing. And sometimes I see people just kind of end there. And I'm like, that's fine maybe if you're going to the bank and you're like, yep, we're going to invest this much into marketing. We're going to do this much into physical renovations. But for me as a business advisor, I'm like, what do you mean by marketing? Like, let's actually talk about it, because that's marketing specifically is one of those things that can just immediately suck away all of your money. Sure. And you don't know what the effect was, what the ROI is, if there is any. And so that can be very dangerous. So I look for those more detailed kind of lists, but that is 100% an indicator of like, you haven't done this work.
Right.
Like you don't know what you're actually going to use the money for.
Right. And that answer, the end answer can be a team effort between the business owner and the lender to say, all right, this is what is probably the appropriate amount. But if you're looking to start from scratch and the lender tell you what you need, that's not a good scenario.
Not a way to kick off that relationship. No, that makes sense. I definitely want to dive into the business plan here in just a second, but first we have to touch specifically on the credit score.
Okay.
So what is your range of credit scores that you're looking for? Kind of what's the bottom tier, and are there different credit scores that are more preferable, obviously, kind of as you progress through the amount that you're looking for?
Sure. So no, it's not really based on the amount that you're asking for that we're going to look for a different credit score. And it's really, my answer is really not going to be about the score. It's going to be what's on your credit report. So regardless of what your score is, we're going to look at, do you have delinquencies, collection accounts, charge-offs, history of late payments? How much revolving availability do you have? Are you maxed out on all of your revolving credit? Do you have a lot of recent inquiries on your credit report? Those types of things tell us more than what your score does. All of those things can have an impact on your score. They do impact your score, but more than the score itself, we are going to look at all those factors. Somebody who's coming to us, and if we're doing a limited review of that, we're not doing a deep dive of comprehensive underwriting, and we see that you've got a bunch of inquiries recently, even though those could be justified, you're buying a car, or, unfortunately as business owners, everyone that you do business with wants to run your personal credit, and that sucks because it has negative implication. It affects your personal credit score. It shows on inquiries, but to the bank on that limited review, we're like, all right, well, is there a reason why they have so many recent inquiries? What's causing that? And sometimes there are justifications as to why there are recent inquiries or a higher number of recent inquiries.
And so you'll have that conversation. Will you have that conversation with a business owner to determine what those are? Or is it just too much of a red flag and you're like, yeah, it's just not going to work?
This may not be a great answer. It depends.
Okay.
It depends. In some instances, it's kind of just, usually that in and of itself does not make or break a loan approval. It's that tied with, if that is, we see that along with they're maxed out on their credit cards, that sometimes can be an indicator there. So it depends on what we're seeing as a whole. It also depends, how long you've been in business. All those different types of things, the industry that you're in, all those can play a role in the bank's review of a request. It's really not the score. Look, everyone should want and thrive to have a good credit score and maintain a good credit score. But it's really what's on that credit report that we're going to focus the most on.
No, that makes a ton of sense. When it comes to just getting some clarity around the documents and things, so the tax returns you're looking for are the business tax returns, but then the credit score is your personal credit score, and so for the actual owner or owners of the business. Can you dive a little bit into the difference between a personal credit score and a business credit score? This comes up in conversations a lot for us.
Yes.
And so I typically, the guidance that I give is don't worry about the business credit score. Like that will come. But what you need to focus on now, if you actually, to get started and to get moving and then eventually to grow, we need to focus on the personal side.
Yes. And I would agree with that advice, is focus on the personal credit report. If the business doesn't have a business credit report, it does not mean that you don't qualify for bank financing. If you do have a business credit report, we want to see what's on there to make sure that, again, you're not delinquent, you don't have a history of delaying payments. Business credit reports look different and have different types of information on there than a personal credit report. And it's very hard, outside of just paying your bills on time and making sure that you have good relationship with your vendors, to control what goes on to that business credit report. On the personal side, you can manage your revolving availability. You can make sure your payments are on time. It's kind of formulaic and cut and dry. On the business side, sometimes, and when somebody says, well, what are you seeing on there? It's very hard for us to give guidance on the business credit report side, because sometimes, and this isn't helpful to anybody, it doesn't show who the vendor is that you are late to. It might say a industry that you're late on, or that this is the industry that's reporting that. And so it's very hard for us to be able to say, well, this is what you need to fix, because you don't know who to go to fix it. And a lot of times on both business and personal, judgments or liens, if it did happen, obviously you want to avoid that. But if it did happen in the past, hopefully you rectified it. Keep good records of that, because that information doesn't always report back. The actual judgment might report to the credit report, but the satisfaction of it doesn't. So keeping that ready in case it comes up is important.
Yeah. Keep your documents, folks. Keep all of your documents. That's really good. I appreciate it. There can be a lot of confusion there, but basically the bottom line kind of takeaway that I get from that is treat your business the way that you treat your personal finances. Make sure that you're paying the people that you promise to pay them on time. Keep good relationships, and just do right. Like if you make obligations, like fulfill your obligations. From the business's perspective, look at the business almost as a person, and that kind of thing. If you do that, then you're going to be on the right track.
Absolutely.
Okay. So we dove into a lot of the aspects, the things that you're looking for from a business owner coming to you looking for that. One of the things I want to go into a little bit more, we've touched on the business plan. So what are you anticipating seeing? What are the differences between a good business plan, a mediocre business plan, and the back of a bar napkin?
So having realistic detail and you acknowledging what certain hurdles might be in the successful rollout of whether it's a startup or the next phase of your business, being realistic. Because if we see trends in certain industries and we don't see that you acknowledge them, then we're not going to put much weight in or faith into you that you recognize what some hurdles might be in your business. So identifying those, putting them in, telling us how you're planning on mitigating it, including your personal experience in there. So like I said before, if you have industry experience, talk about that. If you don't have industry experience, even if that is going to be problematic to the bank, at least talk about how you're going to overcome that you don't have experience in that, or how the skills that you've developed in your field are transferable to the business that you're looking to start or buy or expand. You could talk about that.
So don't hide the shortcomings. Don't hide the things. If you have an inclination to not touch on something, which is like, that's not going to be a good look, that's the place that you should focus on developing a plan and showing that kind of upfront. That's like, listen, acknowledged, I don't have a ton of experience. I have a good amount of experience managing this type of business, but actually working in it, I don't have that experience, which is why I hired this person, and this person who have a combined 35 years of experience in the actual operations at this level.
Yes.
Okay.
Absolutely.
Perfect. So when it comes to trends, this is something that also comes up a lot. And this goes, oh man, I love people that want to start their own business and they got the motivation, they're going out there. But a lot of times people want to avoid the business plan area altogether. And the ones that acknowledge that this is really important and they really need to do it, if they still really don't want to do it themselves, then they'll hire it out. And what I've seen, and I'm curious for this because this goes directly into the conversation about trends that you were talking about. We'll get this 35-page business plan back. And for me, I feel like this is like perfect kindling for a fire. It's just, there's not a whole lot in there because it's not from the actual business owner. Like, sure, they'll consult, maybe they give them a little background on the business and stuff like that, but then they go and do their own research, like this third-party business does their own research on the industry, on the trends, and pulls them in. But the trends that I'm typically seeing from them are worldwide and national. And so I'm curious for you, is that a problem? If that's the case, I typically recommend for them, like, yes, you can put the national trends in there, but if you can find something that's more detailed, more specific to your actual area, like if you can find it at the state level or even in this region of the state, like that would be even more beneficial than just this, because just because something's happened nationally doesn't mean that it's having that same effect in every single part of the states. So how do you interpret that?
Well, you know, if we get a, you know, thick business plan, 35 pages, then it's usually filled with, you know, positive outlook graphs with revenue and trends going upwards. We don't need that. So I would say what we're looking to see is more focused on the business itself and the local area of how they're going to be successful, rather than national trends or just, you know, this industry is proposed to be $5 billion in the next 10 years. It's like, that's great. That's not really telling the bank how you're going to be successful in that $5 billion industry. So focus on yourself, focus on the business, focus on how you're going to be successful. And especially if you're looking to disrupt not an industry, but, you know, your marketplace, and you realize that there's no good service provider for whatever it is that you want to go in and do, then talk about how you recognize this is what this industry needs and this is what our business model is going to look like. And we don't find that in the competitors that are offering it in this space. So that type of granular data is much more better. The micro information is much better than the macro information. Macro information, we can pull the trends ourselves. We don't need it in a business plan.
Exactly. I've even recommended people go out to businesses that are in the area that are going to be competitors, and even go with one of the manual little tickers and just keep track of foot traffic, or how many, if you're looking to start a pizza business, how many pizzas are going out for delivery throughout the week. Like, do your research, actually do the things that other people are unwilling to do. And when you come up with that data, you can say from this week to this week, this is how many people came in. This is I've developed my own background pattern for Mondays look like this, Tuesdays look like this, and this is in this area, and this is with the number one competitor that I'm going to have to deal with.
Right.
And so that type of information, for me receiving that, it's like, this is like, you've done the work. Like, right. you're actually going
it's thought out.
Right. Exactly.
Yeah, it's like the local pizza place that you see in your town closes, and then another pizza place comes in right after, and it's like, well, what's the difference?
Right.
Why is this pizza place going to be successful? And so from a bank's perspective, like, that type of information would be helpful, showing that you've done that market research to know why will I be successful?
Mm-hmm. Yeah, you've got to do the work. You've got no one else is going to do it for you, and don't be afraid to actually step out. We lean heavily on the internet, on websites, in order to find the information that's out there. But a lot of times that granular level of information is like, you got to go out and talk to people. You got to go out and do the work yourself. But then again, then there's libraries. Actually, I didn't know this for the longest time, that libraries have a tremendous amount of local data that stays up to date much more frequently than census data. And so you can actually go to your local library, and for that locale, they're going to have, depending on the library and what they offer, but a lot of them have a business center. And so you can actually go to them, and then they'll at least be able to give you the accurate kind of demographic data for this in this area. And so if you understand your target market, and you can see that this is a trend, that this population group is growing in this area, then that's information that you can put into there. And it's like, the people that I serve, it's trended from 25%, then we were at 30%, now we're at 33%, looking over the next couple of years to be about 40%. Like, so my potential target base is just increasing. And that's not information that you're going to get from the census.
Right.
So it's, going out there, doing the work, understanding the resources. That's why you guys are there. That's why we're there, to help point them in the right direction, to make sure that they have this. There's a lot of conversation right now in the world about interest rates. So I'm very curious about some terminology that's used, and trying to help translate some information for people and try to give them the best information that's out there for the different types of lending and things that we've talked about already. So first, what is prime? What is a prime rate? What does that mean? So
prime rate is the rate that most banks will use as a base rate for typically variable-based loans. So, for example, our lines of credit are prime plus 0 or prime plus a margin, and they're using prime as that base rate that is set and is very dependent on where the Fed has.
I was going to ask, is it the same thing? Is prime the same as what the Fed interest rate is putting out?
No, it's not exactly, but it's heavily influenced by. So when the Fed raises the Fed funds rate by 0.25%, you're going to see the prime rate changes up or down by 0.25% at the same time. So it's not exactly the same, but it's heavily influenced by that. And that's primarily, most banks are going to use that as their base rate for lines of credit. And also the SBA uses that as well in their products.
Is prime consistent across banks, or is it prime different? Okay.
No.
So what?
The prime rate will be the same regardless of who you go to. It's just if there is going to be a margin on top of prime, it's really what that margin is.
That's where the competitive nature between different lending institutions comes into play. And so what is prime right now?
8.5.
Lord. Okay.
Yes.
So for your different loan packages, your different loan types, what are the kind of interest rates? Like what it's prime plus what for the different ones?
It can range, and this is really lines of credit. We could talk about the term loan rates. Really the different lines of credit are going to be variable rates. Term loans are going to be fixed rates.
Got it.
The term loan, you're not really going to see it based off of prime. The bank is just going to give you, based on their approval matrix, what the rate is.
So it's based on your information.
Correct.
Okay.
And as well as the marketplace, where are rates today? Okay. But talking about where prime is, it could be anywhere from prime plus 0 to prime plus at the high end, really 4 or 5% on top of prime.
And what shifts that? Is it the individual's credit report?
Yeah, it could be length of time in business, industry, pretty much any risk factor to the bank will increase that risk. Okay. Whether it's conventional line of credit through the bank or whether the bank is using an SBA guarantee can also influence that rate. But so length of time in business, industry, and also what's on that credit report.
Okay.
So obviously that's a big risk factor.
Perfect. So the last thing that I wanted to touch on is kind of what are the biggest and most common problems that stop businesses from actually getting a business loan?
If we are doing a full underwrite where we are doing a cash flow analysis or a collateral analysis, the most common reasons that they might not get financing is because the financials just don't support what they're asking for. We could always counteroffer it to a lower amount, but typically if cash flow is king, so really the bank's going to look at cash flow, collateral, and credit. There's other factors, but those are your main three. You could have an 850 credit score. You could have millions of dollars of collateral.
If you can't pay the minimum
amount. If you can't demonstrate that you have the ability to repay the loan, it doesn't matter. The bank's not going to be able to do it. The bank needs to be able to demonstrate that you have the ability to repay.
Got it. And so if someone is looking at getting that loan and they're seeing the revenue they have now and they want to make sure that before they go and have this conversation that they have the space to be able to make the payments on it, how would they go about figuring out that payment amount?
They could use, they could just Google a loan calculator.
Perfect.
They could go, TD on TD site. There's a loan calculator they could use. If they're already engaged with, somebody like myself, a relationship manager, you could have that conversation saying, I'm not sure exactly how much it's going to be, but based on 5 years or 7 years, what is my payment going to look like?
Okay.
But, really Googling it, you're going to get a loan calculator that's going to be able to self-serve that purpose that you can build into your projections.
Got it. That's perfect. Any last pieces of advice for businesses out there that may be considering getting lending or just want to understand more about this space?
Start with the bank that you have established a relationship with. If somebody comes to me and they're banking somewhere else, I say, well, why are you coming to me? Is there a reason why you haven't gone to your bank? It could be a red flag, but B, that's the reason that you are developing a relationship with your bank is so that as your needs grow, you can grow with that institution. If you determine that the bank that you've been banking with is really not best suited for your financing needs, then you could start to shop other banks. It's very easy to get into the online lending marketplace, the merchant cash advance marketplace. They're going to advertise that we'll have you money within 24 hours. Very enticing. I would recommend people stay away from that because you don't know what you're getting into. Like I said earlier, it's somewhat of an unregulated industry, and you don't realize sometimes what you're getting yourself into until it's too late. And sometimes those facilities are hard to get out of. So if you could stay away from those, that would be ideal.
Yeah, if you're in a position where all the banks are telling you no or all the financial institutions are telling you no and you're going to those, maybe it's time to take a step back and look at what are the reasons, why are they telling me no, and what are they telling me to do, and maybe I should just do that. And instead of going to those hard.
We like to say that yes is a great answer to a loan request. No is not the answer that you want, but it's not a bad answer. Maybe is a bad answer. If we can't tell you why you're not getting a loan or that maybe we could do it, there needs to be an explanation behind it. If we're saying yes, great. If we're saying no, hopefully your bank is telling you why. Pretty much the bank should be required to tell you why.
Yeah, ask them if they're not telling you.
And sometimes it could be no right now, but fix these things and come back, and then maybe it could be a yes.
Perfect. Scott, I can't thank you enough. Absolutely incredible. So much valuable information. So thank you for coming on the show.
Great to be here. Thanks.